All right, we will go ahead and get started. Hello, everybody, and welcome to our Everything ESOP webinar. My name is Christina Tucker. I'm the marketing manager with SEK. Although I don't think anybody came to see me, you are welcome to message me privately if you're having any issues or need assistance. You can do that through the chat feature. If you have questions throughout the webinar for any of the presenters, please don't hold them till the end. Go ahead and you can ask them in the Q&A or the chat, whichever is easier for you. If you're using the app, there's also a raise hand feature. You're welcome to do that, and we can give you permission to speak, and you can ask your question verbally. So I will turn it over to Nathan, and we will get started.
Awesome. Thanks, Christina. And thank you, everyone, for joining us. We're glad that you were willing to carve out some time on this, what has now turned out to be a snowy day, at least here in central Pennsylvania. If you're scattered around outside of our area, you may not be experiencing that weather. But as Christina said, we wanted to take some time today to focus on ESOPs, employee stock ownership plans. And I think in a lot of discussions that we've had with our panel, which we'll get some introductions out here in a minute, we just realized that there's a lot of maybe misconceptions about ESOPs that are out there. There's a lot of misunderstandings about how they work, how they can benefit your organization, how they can help create a different type of company culture, but also the negative aspects of them. When aren't they right? What are the prohibitive features of them that may not work for your organization? So we wanted to lay some of that stuff out there to really continue to provide education for all of you to ultimately, if nothing else, help you understand them better, possibly though, and open up an opportunity for a conversation to see if it may make sense in your business, assuming that you have one. So by way of introduction, I'll start with myself. I'm Nathan Imboden. I am the president of a firm called Questmont here in central Pennsylvania. We run what we call a virtual family office where a big focus of ours is doing exit planning work with business owners. And through that, we created this BORN team and BORN network, which stands for Business Owners Resource Network, which is built to cater to the needs of business owners heavily around exit planning. So we have a carefully vetted team of CPAs. SEK happens to be our member firm, attorneys, both on the personal and business side, mergers and acquisitions groups, investment banks, benefits consultants, you name it. We have heavily vetted experts that we can bring to the table to make sure that clients that we're engaging with, business owners that we're engaging with, can get the best advice possible. I'll turn it over to David and let him introduce himself.
Thank you, Nathan. David Maaskant with SEK CPAs and Advisors. I have the privilege of managing our business valuation department, which dovetails into a lot of our transaction advisory work. And I get to do that for our entire firm, which, covers 6 different offices, from Pennsylvania down through Maryland. And I'm also, appreciative that I'm able to be a part of the BORN team that Questmont has created. And, in a lot of those conversations, like Nathan had said, we get into deep conversations about the succession of a business or how to sell a business. And I would say in, 90% or greater of those conversations, ESOP comes up. And I certainly don't know, I'm not the expert on it. That's why we have our panel here today to help educate us a little bit and help educate, our clients and the community.
Yeah, awesome. Thank you. Michele, why don't you introduce yourself?
Yeah, absolutely. I'm Michele Hammann. I'm the Chief Strategy Officer for SSC CPAs and Advisors. We're based in Kansas, and we are a CPA, an ESOP-owned CPA firm. So we can talk a little bit more about what that looks like, which gives us a unique perspective to be able to help explain to our clients what being an ESOP actually is. What does it look like? We do feasibility studies, and then we help with implementation of ESOPs before doing the pre-work, and then also staying with them afterwards. I'm a certified valuation analyst, and we have 3 others here in our firm, and we also work with our clients as certified exit planners. So we help them kind of discern what might be the right place, and we actually kind of start working on this. I'm sure Nathan knows, not 2 years before they want out, not 3 years before they want out. something that we start
6
talking.
months, right? Oh,
Yeah,
no,
6 months,
that's,
yeah,
yeah,
6 months and we're peace out, and so it's something that we start talking about, 5+, 7+ years
Yep.
in advance. So thanks for having me, guys.
yeah, awesome. Glad to have you. Nate?
My name is Nate Bunty. I am a commercial insurance advisor with Murray Insurance in Lancaster, Pennsylvania. Murray has been managing a executive liability program for ESOPs and endorsed by the National ESOP Association for approximately 30 years. There are special needs that ESOPs have in regards to executive liability, and we crafted a program for that. As a matter of fact, we have clients all over the country, because in addition to selling it directly, it's also sold through other agents and wholesalers. It's just that specialized of a product. In addition to that, and outside of ESOPs, I help executives and owners find financial levers that they can pull that other brokers don't talk about.
Awesome. Well, if those introductions weren't evidence enough that we have a great panel here to provide good information, I'm not sure what else we can do. But I want to start by just maybe giving some background and maybe on the landscape of what we've seen here over the last couple of years, at least from our perspective. And Nate and Michelle, you can feel free to chime in differently. But the last 2.5 years, let's say maybe post-COVID, we had really kicked off during what was coined the COVID bump, where there was just a tremendous amount of acquisition or sale activity that happened, most of it being external. There were a lot of private equity firms coming in or large investment groups that were coming in and buying up companies, whether it was through platforms or roll-ups or whatnot. But one consistent theme that I think still was being talked about all the time, and anybody that's a business owner on here probably has been dealing with the challenges of how do I attract quality employees? How do I retain people? How do I keep a culture that is engaging so that people don't want to leave? And that didn't change, but it seems to be a little bit more of a focal point in conversation right now because some of that activity that had gone on over the last couple of years has dried up as we've seen some economic pressures. We've seen interest rates increasing, so loan rates are going through the roof, which means that the cost of capital to acquire these businesses is going up. And it felt like it was very timely to get this information out there because as we talk about culture and stakeholder value and all those kinds of things, it's a very relevant conversation. So maybe what we can start doing is, Michelle, maybe I'll kick it to you and just giving us the maybe 10,000 foot definition of an ESOP and how it works.
Yeah, I can do that. I hope. 10,000,
maybe 5, maybe 15. I'll give you a range. Actually,
Okay,
tell you what,
perfect.
we
Yeah.
talk about this concept of a range of values, and most times, most things that we own has mainly one value. Our real estate probably has one value. If we own publicly traded investments, they have one value. But a privately owned business has a range of values, and it's all related to how that business eventually transfers. A business is worth way less, much less, if you don't have any sort of succession plan. You have to do a fire sale because of a illness or a liability issue or whatnot, compared to a well-run machine with a leadership team in place that can function without the owners, and it's plug and play. So it's important to know that every business has what we call a range of values. An ESOP falls somewhere in that range and how it's valued. But I thought I would just throw that out up front.
Oh, no, I think that's a really good point. I mean, the standard definition for an ESOP transaction is fair market value, right? And fair market value is determined based on a number of factors. One of them is how well your business may compare to another business like yours that is sold recently, right? And then so you start comparing those attributes that you mentioned there, Nathan. Like, is there a great management team in place? Do they have all of the controls surrounding their client list and retention and goodwill? Is there a risk in that key owner? Is it that one person? It's probably not worth as much if the whole business is based on that one person. And so that's the fair market value standard by which it's judged. So and there is a with an ESOP, who the buyer is. You know that the buyer is this trust that is established to buy the stock of your company. And so, at that point, the standard is fair market value. Sometimes when you go to sell your business, there's a synergistic value. And so this is where maybe your business might be worth more to your competitor down the street than it is for fair market value to your ESOP, right? Because they're going to make changes. They don't need your accounting department. They don't need all of the other things. They're looking at a synergistic, good enough, purchase for that, for that component. And so it might be worth more to them than it might be worth to an ESOP. So that is something to kind of keep in mind too, as you're weighing your options for exit. That's kind of where we start, is saying there's a number of ways to exit your business. One is the exit sign out the back door, the fire sale that Nathan referred to, not highest and best take home for the exiting seller. It's selling maybe to your employees, maybe selling to your competitors or other places. And when I say selling to your employees, that's two different things. There is selling to a key management team, and then there's an ESOP. So that's probably one nuance that I want to make sure that we talk about a little bit about today, is that an ESOP itself it's essentially a 401k plan where the only stock, the only asset at the beginning is the company stock. So it's governed by the ERISA rules, it's governed by the Department of Labor, and it has the components of an employee benefit plan as opposed to just ownership. So I know we can get a little bit more into that.
Yeah,
I think that is an important consideration to start with.
Yeah. Well, and I think maybe to add to that, well, the ultimate goal is to figure out a way to use an ESOP to take a privately held illiquid business and actually create some sort of what we call create a market for that by using the ESOP to create share ownership for the employees in the organization.
Yep. And then using the cash flows generated from the business to be able to buy the shares, to be able to pay off the owners who are really selling into this marketplace that we just created through this ESOP, this trust that holds the shares of the corporation.
Yeah. So maybe before we dig into some of those details, why don't we just answer one question that had come in, which was around general metrics on, are there baseline employee numbers or revenue numbers or financial metrics that an organization should fall under to even think about considering an ESOP?
I've seen some pretty small ESOPs with maybe, 15, 25 employees, I think is probably the smallest I've seen. With it, I think the most important financial component is that you do have consistent cash flow from your business. Yeah. An ESOP is not a good fit for a business that can be incredibly cyclical based upon on cycles out of your control. So like a lot of the clients that it works really well for us is our engineering firms that have longstanding reoccurring contracts. It isn't a good fit for one of my engineering firms that does disaster recovery. We don't know when the next disaster is going to hit. They're going to do super great 2 out of these other years, and ESOP isn't a really good fit for them. So you're looking for a consistency in earnings, and then if it's smaller than 15 employees, you could probably get there through just direct ownership in a company as opposed to just setting up an ESOP, because with an ESOP you have all of the plan administration and all of those considerations to take in. So if I see a place that is maybe only 8 to 10 people, we talk about how do we form an ownership group and let them start buying it out. So it's kind of it's a right fit for the type of business and the management structure and the management team that you have in place that you're planning on transferring it to.
Yeah. Is there a deal size that that is too small, even if they had the number of employees. But if the company's value is coming in too low, or what's maybe the bottom line, say value of a company to even begin to start to consider an ESOP?
Yeah. I mean, what we haven't talked about is that the tax benefits of an ESOP. And so it's really a dance between the tax deductions that you receive and the cost that you have to spend to administer.
Mhm.
And so if the amount that you're paying in to get the tax deduction doesn't cover the, I can just put like plan administration's 10 grand a year, right? So you kind of get to the point of setting all of that up and net cash doesn't come out to where you need to be, then it's probably not worth it. And you should probably look at doing just direct ownership for the people who can afford it.
Yeah.
Makes
Well,
sense.
talk about some of the mechanics of, because you mentioned a general, we'll say baseline automatic has to have this in place to make an ESOP work. But you talked about consistent cash flows.
Yeah.
And there's a specific reason why that's relevant related to ESOPs, and has to do with how ESOPs are set up and then funded on an ongoing basis. So maybe talk through at a high level those mechanics so we understand a little bit better how they're opened, paid for, contributed to, and how the employees or participants in the ESOP then what their contribution or responsibility is.
Yeah, man, that's a big question. So let's see. So
I ask big questions. Sorry.
that was a big question, Nathan. Nate, jump in anytime you want to backstop me on this one. This is a big one. Okay, so essentially, you're setting up a retirement plan for your team members, and a retirement plan will have essentially minimum contribution rules. Those contribution rules aren't based upon ERISA rules, but the amount of debt that is inside of the ESOP. So let's say the ESOP bought $1 million worth of shares from the exiting group, and that they went out and got a loan to buy those $1 million worth of shares back. They're strapped. They have to put in enough money to at minimum cover those loan payments. And so at that point that you have to have that much cash flow just as a baseline to be able to make sure that it's essentially taking a loan and making sure you have enough money to cover it.
Mm-hmm.
And then over time, those shares, as the payments are made on those notes payable, those shares are allocated to the participants inside the employee stock ownership plan. So they are credited to the individual's accounts, and they're getting shares in the company held in the ESOP. Those shares and those values are increasing over time, right? Not decreasing, increasing over time. When those individuals choose to leave, the ESOP has the requirement to buy those shares back. They buy those shares back from the exiting participants. And so we set up plans so that if they're big enough balances, you can buy them back over 3 years, 5 years, so there is some cash flow mechanisms, but you then have to put in enough cash to make the loan payment and to buy the shares back. So it generates what's called a repurchase liability. And this is how much money over time we're going to need based upon how often people retire, how big their balances are, all of those things. You generate about a liability that the company has to fund. So you want to make sure that there's plenty of cash flow to be able to not to meet those needs, because it would be a DOL problem if you don't.
Yeah.
Yeah.
All right. So do employees and or participants contribute any of their own funds into an ESOP to buy shares?
That's the best part. It's free money.
Right.
For our employees, that's what and they don't even have to opt in. They're getting in either way. We just have to you're in SSC, you're in our ESOP. And so we make the contributions on their behalf. Just for some for our ESOP, just to provide some clarity or some frame of reference, we probably put in based on gross wages, an additional 15% of compensation is what is going into the ESOP. So And we have an ESOP that has most of our debt paid off. And so this is really for repurchasing of shares.
If I may, I mean, to circle back to something you had said earlier, I mean, as we've gone through COVID and we had the great resignation maybe in 21, and a lot of us weren't, sheltered from that. I'm sure there are statistics, but I would imagine an ESOP owned company was a little bit better sheltered. And it's a little bit off the technical topic, but do ESOPs create a certain culture within organizations? And then does that shield those organizations from maybe having such attrition, during certain economic times?
I think so. I think that, I want to point out, like, the ESOP the concept of the ESOP creates that culture, but you as the leaders of the company have to be really purposeful about it. Reminding people of the benefit, reminding people what it means. Like, it is work to educate, to see. And, David, I think it did help us. It did. And the people probably from the 5-year on mark with SSC, those people are getting their statements. Like, literally, I still make them print statements. We could do this online, but I kind of like the like the pageantry of the whole thing, right? Like, we have a party. Here's your statements. Oh my gosh, you've been here, and nobody opens it and shares it with the other people. That would be terrible. But some of these people who have been here, whom are making 80,000-90,000 a year, who've been here for 10-12 years, have $150,000 of stock, in addition to their 401k,
right.
That has been put aside for them. So, they see it, and then we do a thing where we have an outside valuation done by a third party. So Nate, it'll be okay for the trust liability, right?
Yep. external appraisers and whatnot are always an advantage when it comes to executive liability, of course.
We're doing it. And so, like, literally we get the outside shareholder or the outside value. We do guess our stock price, and we talk about why it's up, what we can continue all to do as a team to make it go higher, and so, because we're all pulling in this together. And it really creates kind of a cool culture, an accountability culture too. Like I mentioned, I think it'd be super cool if we could get a share in a jet, because I'm really sick of sitting at the airport. Immediately it was like, not through the ESOP.
Yeah, and in addition to financial concerns, it's something that our safety teams focus on when they're in an employee-owned company as well. It could change, not just like, people aren't stealing paper clips out of the filing cabinet or whatever, but when they understand the costs associated with employee accidents, soft costs in addition to the hard costs of workers' compensation and having your rate going up, communicating that to an employee-owned company creates more conscientious environment of safety, and where some people who may have been tempted to cut corners in the past when it's employee-owned in safety and process and whatnot are less likely to do so.
We absolutely see that, Nate, because I'll even say, you guys, we need to increase our fees. These are the things. And they're like, absolutely, we're increasing our fees. I've got a whole team.
Yeah.
Because they understand costs are rising. Like, they really participate. And it's not just some talking head says it's time to raise fees. They know that it helps with our bottom line too. So.
And you were talking about professional firms. When I was in high school, and actually this is a question I have for you, but when I was in high school, I worked for a grocery store in a local area that's employee owned.
Yeah.
And you'd think just grocery store clerks and stuff like that. And some of the kids that I worked with were 18 and were participating in the plan. And when they turned from 17 to 18, because you have qualified employees, whether or not, and it changed their attitude a little bit about how much we just sat around and shut the shit necessarily between like getting stuff done. So it's interesting.
Nate, so they're Publix, Winco, Harps, and Brookshire Brothers, all supermarkets, all ESOPs.
Yeah.
So,
ours in our area is called Redner's Warehouse Markets. That's where I worked when I was a kid. Yeah.
And you know what? Consistency. It's consistency in earnings, right? I mean,
people got to eat.
People got to eat. And there was a spike, right? There was a spike in COVID when we cleaned all the shelves of every supermarket. But other than that, it's usually pretty consistent.
Yeah. Hey, if you're an egg supplier right now, you're spiking for sure, right? Yeah.
We did
Michele,
receive a question through the chat here. How are shares distributed to employees? What is it based on, wages, or can management be treated differently as it relates to shares?
Oh, what a great question. You want me to do that one? Yeah, okay.
Oh, yeah.
Yeah. So that is it's a mathematical equation based on compensation. So it's eligible compensation for that individual divided by total compensation, total eligible compensation of the group that's inside of the ESOP. So there is no real special consideration that you can do inside of the ESOP. What we typically see when a company is 100% ESOP owned is that they start adding additional compensation plans that may mirror or supplement for their management groups. So they'll start adding kind of like, I call them phantom stock plans. Other people like synthetic equity, but I don't think people know what that means. They don't know phantom stock or shadow stock plans where you can set up compensation for a specific group of individuals that may be based upon the increase of the stock. Just some deferred compensation plans as well. So it's all fair treatment according to the ERISA standards inside of the plan.
and that would lead to the testing requirements, Nate, on the risk management component of it, that all those rules have to be followed so that it's structured properly. Nate, maybe why don't you go into some of that, the risk management component and the partially the work that you guys do, but maybe how you help, how the risk management work helps protect the ESOP, and then maybe just some general pitfalls that are potentially present within an ESOP plan that need to be addressed.
Well, sure. A lot of times, actually, we come into play after the ESOP has been formed or as it's being formed, and we help protect the executives from liability, because becoming an ESOP changes your executive liability profile, in that you could be a little bit more susceptible to governmental action by the Department of Labor. And Michele had mentioned about having the external auditor. External trustees are a good risk management practice as well, having a third party that helps guide the ESOP. But it's not necessarily required. You know what I mean? Like, you can create your ESOP sort of however is going to work best for you. That where the danger comes in is that if you have a D&O policy or directors and officers policy now, that policy almost assuredly excludes ERISA action, which would be like Department of Labor investigations and fines, as well as just ESOPs in general. So if you don't have a plan that's built specifically to cover ESOPs, you're lacking coverage. In addition to that, something that we've seen some companies don't have: employment practices liability, cyber liability, and some other of these sort of manuscripted coverages. And we recommend getting that into place because that's balance sheet protection. You're talking about having consistent revenues. If you have been sort of self-insuring your cyber risk, and now you're an ESOP and you're relying on that consistent revenue year after year, then having the massive cost of a data breach, with the reporting requirements, can really impact that cash flow for the year or maybe for years to come. So having transferred that risk to a third party is a best practice at that point. Did that answer the question that you were looking for? The other thing that I wanted to go back to the culture thing. When you're a new ESOP, when you're going into becoming an ESOP, that's something that Murray has done in the past, is to have like kickoff meetings where we introduce the ESOP to the employees, however you design it. Again, we're not really involved in the creation of the ESOP. We're involved in helping you protect it ongoing and into the future. And we've been successful helping build that culture through that consistent communications, either through our HR consulting that we've done, as well as safety consulting, direct to employees, because for companies like that, we become a member of their team to a certain extent.
Yeah. Yeah, we all would love to believe that giving somebody free money would be enough motivation to just get excited about something. But we also live in the real world and know that you gotta sing the song many times and build that
Over and
awareness.
over. So I've done some weird things. So like we've handed out little bags of gold chocolates when you get to be in the ESOP. You get your little ball of gold. Like a physical reminder.
Yeah.
And then in ESOPs, when you design them, you can put in employees vesting in their actual shares, right? So that they have to be with you 3, 4, 5, 6, whatever your vesting schedule is. And so when people vest in the ESOP, we buy them ugly vests for them to wear around the office.
Well,
Just
that's
like,
magic.
Yeah.
Invested.
You've
That's
invested.
awesome.
And it's just kind of like like just another way to keep it top of mind.
Right.
Yeah.
If not, it's a statement they get once a year.
Yeah.
And so it's just fun ways to kind of to make it part of the culture.
Well, you mentioned it earlier, Michele, about you can put this kind of a plan in place, but if the leaders who are in charge of it don't try to view it through the lens of the participants and create something that's really different and unique, rather than just, it's like a bonus, but maybe a thankless bonus. I'm just directing you a check and here's some money, but you're actually doing something unique and maybe memorable that it just creates a different feeling.
I firmly believe that.
Yeah.
Nate mentioned something too about like the conversations. You said something about having conversations with the employees. I'm curious, for anyone considering an ESOP, what does that conversation look like? Maybe like with the owners, and then how do they disseminate that information? Like, we've decided to move forward with an ESOP. How does that then?
Most recent example, we had a contracting company. It must be a contracting company with consistent revenues, but a contracting company become an ESOP, and they had a kickoff meeting at their at the local minor league baseball stadium. Has a like an event hall essentially, and we ran that meeting. Our program manager for the ESOP program and another gentleman here at our office that helped form our ESOP program basically just went over the benefits of what it is, the things that Michele has been talking about, the kind of how they're getting free money, how they're going to be owners in the company. And when you're an employee owner, compare that to being a shareholder. Even if you have direct shares, not in like a mutual fund, say you go out and buy some Apple stock, you know what I mean? And you might say, well, I'm an owner of Apple, but you don't have any sort of influence on what happens at Apple, right? When you're an employee owner of, even if it's maybe 150 or 200 employees in the agency or in the company that you're in, your day-to-day impacts the performance of that company. And we try to really convey the ownership. Everybody should own their day, right? Everybody should own their productivity, whether they work for, a huge Fortune 500 or mom and pop style business. But when you're kind of in between there, when you're one of those employee owners in a company like that, you really can get the feeling that your day-to-day has the most impact on the company, and by having that impact on the company, you're having a true and impact on your financial future. And that's something that we try and convey. And in addition, when say you've heard of activist investors, right? So you kind of create the possibility that you might have some activist investors that work for you. And again, that's where executive liability, because you create a new style or a new potential claim from your employees, because now they're essentially they're shareholders, and they could decide that the valuation's incorrect, or you're not doing the right thing as the leader of the company. And again, if you don't have the proper risk transfer in place, that could impact those that can impact those balance sheets from year to year, and whether they file suit or if they call the Department of Labor, because the Department of Labor loves stuff like that.
Yeah, they do. Well, either your timing is perfect or you saw the question and answer window, because one of the questions that David just asked is, can a manager be fired by a lower level employee? Now, I don't know that it's the same thing in line with the activist shareholders, but kind of along the same lines. What control does a lower level employee have in terms of influencing employment or that kind of stuff?
I think that's really going to come down to what your employee handbook says. I mean, probably not. I mean, management structures aren't thrown out of the window just because the secretary might be there for 50 years and, you're still the CEO. You know what I mean? Like,
Right.
that's probably a better question for a lawyer. But yeah, I don't think I've ever heard of that actually happening.
So in general, though, the ESOP itself doesn't create a new employment opportunity or engagement opportunity where other elements of actual employment control are created. This is purely ownership in a business.
No, and I think I can speak to that a little bit, just because I know this is a confusing structure concept. It really is, because we have it in our own firm, right? So the shares themselves are actually owned by a trust. No individual person owns those shares. They're just allocated inside of the trust to them. So they don't actually have individual ownership in the corporation. That trust is governed by a board of trustees. And this was to Nate's point of, maybe sometimes we have outside trustees where they don't work for the company. Sometimes it's full of trustees who also work for the company. That group of trustees is essentially kind of they get to vote the shares that are held in the corporation stock. So for SSC, we're governed by a board of directors that are elected. And then we elect our CEO. And from that point on, our CEO just runs the organization. And you would really never, there's no voting individual shares to do different things. So it definitely has to be an appointment being made that there's a trust, and the trust is the owner and you're part of the trust.
Before we move on, I see David's hands up. So I don't know if that covered your answer.
We're gonna let him speak.
Uh-oh.
Yeah.
He's still muted in case he wants to speak.
Wants to.
If he wants to.
It like asks if you want to unmute. If not.
No, he's unmuted.
No,
Okay.
that answers my question. Thank you.
Oh, good. Okay, great.
Perfect.
Well, there's
go
one, I
ahead.
think there. It looks like there's a question in our chat, and so this will be a big one, but and I think we all know where it's going. So, I always say in my practice that not every decision we make should be just solely based on tax. But that being said, there are some very nice tax benefits to ESOPs. Depends on how they're structured, but so we have that came in before. We just had a question pop up. So would Michele, you'd like to address maybe some of the tax benefits that you commonly see?
Yeah, absolutely. So I'll address the first one. And so this is the sell side implications for the owner that's selling into that employee stock ownership trust. They are going to sell their shares into that trust. So they're going to get capital gains treatment on the sale of those shares. I assume they've held them longer than a year. So they're going to get long-term capital gains treatment, which happens to be one of the best rates going around, right? And so with that said, other times when a business owner goes to sell their stock, very rarely are they actually selling stock. Most deals, when they're done, if you sell to an outside party, they're coming in and buying your assets of the corporation. And those are going to end up being taxed at a higher rate for that seller. And so this is the most tax favored way, is selling stock. And with selling stock, you sold it to your ready-made buyer in the ESOP, as Nathan mentioned before. So that is one of the considerations when you're looking to selling to a third party with that synergistic price that I mentioned that might be slightly higher than you would get for an ESOP. You're going to be paying more tax. So go ahead and kind of weigh back and forth on that. Also for the seller. Oh, go ahead.
Because it's specifically related to what you just said. There is also a misconception that the highest price that you can get for some sort of a sale or a transfer of a business is the best deal, because not all transactions are taxed equally and created equally. You just mentioned that a lower valuation on the ESOP compared to a third party or an outside buyer coming in may still result in more money in your pocket because of the tax treatment of it.
100%. Your price, my terms, right?
Yeah.
So we'll get it. It's the way that you set up the sale really impacts what you get to take home with you. So there's one more nuance to the sales side for the exiting shareholder. If the entity that you have is a C corporation that you're selling, there are some special rules that allow you to purchase replacement stock. So you could sell your shares in SSC Inc. and go buy Coca-Cola Inc. and be able to defer some of that gain. I don't have that many C Corp clients. And Dave and I have talked a bit about this, like, is it worth converting and being a C Corp to go sell like that? Like, I haven't done it for a while. And so I don't know, David, are you seeing much of that happen? Or
when that comes up, it usually the family, there's a big estate, and the family is usually pretty well off where they don't need all of the proceeds or any of the proceeds from the sale of their small business stock. So to them, sort of kicking the can down the road as far as the tax obligation and doing that, section 1042, called a like-kind exchange, I guess, into the market, they may never even touch that. So to them, under current law, if they pass away, their heirs get a step up in basis, and it's just a way for them to protect their overall estate. That's when I've seen that happen.
That's right. Most of my business owners need that money to retire. So that's why I haven't seen it. That's a really good point. Because when they sell the Coca-Cola, metaphorical Coca-Cola share there, that's when they pay the gain on the sale of their business.
Yeah,
so, yeah,
you're just deferring gain for a period.
Yes, just kicking it down the road like any other like-kind exchange. But that's not available if you're an S corporation. For part of this, and also to point out that in order to be an ESOP, you need to be a corporation, so you can't be a partnership or something like that. So this is why it takes a lot of planning, is you have to kind of move through some of those steps. Okay, so that's for the sell side. Once you are an ESOP, the business makes payments to the ESOP, benefit payments essentially, into the ESOP to fund the debt payments for the acquisition of the shares and to fund the repurchase of shares from exiting employees. And so you put in that money, and it's a deduction on your tax return. So you're able essentially to buy back, to buy your stock with a tax deductible amount, right? And so that's not something that usually happens, because if you're trying to give your employees more money to be able to buy you out, right? Like that's kind of something that happens. Well, it's a deduction for you, it's wages for them. They have less to buy you out with. Because their wages are taxable. So this is a tax deductible way to fund the buyout of your business. And then the holy grail of this is this is the big one. Okay, so once you are 100% ESOP owned and you're an S corporation, the profits of that S corporation, the profits of your S corporation that were typically taxable to those outside owners on their individual returns, those are all flowing through to the ESOP, and they're not taxable anymore. So and that does happen incrementally. It doesn't have to be 100%. So like if you're 20% ESOP owned, 20% of the profits flow to the ESOP and aren't taxable, 80% flow to the other shareholders and it's taxable. But the holy grail is 100%. That means you're making decisions without worrying about taxes for real, David. Like you said, you're able to retain capital and to do things. And then as you make distributions in that S corporation or dividends in that C or distributions in that S corporation, those are like dividends to the shareholders inside of the ESOP. And so we have some ESOPs that are so mature that they don't just have company stock in them anymore. They have investments in other mutual funds and things like that because they're accumulating those distributions that they're receiving on a regular basis. So that's the most mature ESOP that's really functioning at a high level.
Yeah, awesome. All right, let's let's jump to the we've talked a lot about, I think, some of the benefits, the way it can work, but let's touch on situations where an ESOP won't work well or where we've seen ESOPs fail and just not a good idea.
Nate, do you have any failures?
I do not. I don't have. I mean, I have.
Nate doesn't fail.
Yeah.
I meant about ESOP
failure is not an option.
specifically.
I mean, as not where like the plans failed or anything along those lines, but the danger is like the biggest negative. And again, we work with companies going into and becoming ESOPs and the communications piece and whatnot, is that being an ESOP does put a little bit of a target on your back, maybe more than a little bit of a target on your back from the Department of Labor. And they will audit, they will check your valuation. And if you get into an investigation, you could end up with fines and things along those lines if they disagree with the valuation. That's why the third party appraiser is very important, and having some external trustees is a good idea. It just changes that dynamic a little bit where you're going to be under a lot more of a microscope than you were just as a private company that had like close ownership or something along those lines. Even if, in addition to insuring ESOPs, we also do E&O for ESOP servicers, so that those appraisers and trustees and things along those lines, because they can also be investigated by the Department of Labor and fined. And there's some, it's not, I don't think it's a factor that should dissuade people if all the financials make sense, but it is definitely a new piece of your risk profile for your company, and something that only a select few carriers will tolerate, essentially, and provide the endorsements necessary to protect you once you become an ESOP, because generally speaking, insurers are not keen on paying government fines, essentially. You know what I mean? Because government fines can be a little bit arbitrary and capricious. You know what I mean? Yeah.
Heard of that before.
There was actually a little bit of a success story that I wanted to bring up. Is there was a hang on one second. Let me just bring it up. It was Bowers and Kubota Consulting in Hawaii had been the subject of like a 12-year investigation where they had received a substantial fine, and they fought it and they won in federal court. And the judge was basically like, no, Department of Labor, you overreached, and they swatted it down. So that is a recent case that's providing some hope that may turn the corner a little bit and not be as much of an issue in the future, because that case was decided in like December of 2022. So we're talking like 6 weeks ago.
Yeah.
Yeah.
I'm sure they were adequately compensated by the Department of Labor for the pain.
No, the government always just gets to say, sorry, see you later. You know what I mean? Like, whoops. You know what I mean? So yeah, that, from our perspective, like I said, your risk profile changes when you become an ESOP, and it's something you have to take into consideration. But no, and again, we're not part of like the analysis process. We get involved. We're put on notice, like folks. We're working with several companies right now. They're going to become an ESOP. The transaction is going to close in 2023, and we've known about it maybe for 6 months. And we'll be there when it completes a year after they first engaged. But Michelle, have you seen any where they have fallen apart?
I think, Nate, to your point, I think it highlights the level of seriousness that you have to take to trustee relationship that you're entering into.
Yep.
Just as serious as it is with the 401k. When you have a 401k, you have trustees of your 401k, and it's important that you follow the rules, do the things, but this adds that valuation component. Making sure you're documenting how you selected your valuation company, the rigor that you put on deciding, on accepting that valuation as trustees, and really just sticking to the documentation and having the right people as your trustees. I only had one failure, and it was in 2008, and they were a lumber company. 2008, 2009, yeah. And their CFO, he's not on. I'm kidding. They're not around anymore. He's in prison. So they were going to fail either way. They just happened to have an ESOP as well. So it wasn't a good situation. You don't like to see that. And the only other comment I would have to managing the risk associated with ESOPs is you do have to kind of measure your statements surrounding ESOPs, to your team. If you're telling everybody we're going to do an ESOP and we haven't done an ESOP, like you kind of have to manage the expectations of your team members, because the risk is that you overpromise and underdeliver more so than anything else. And so just being careful and purposeful in your language, I think is probably the other component to managing that risk.
Yeah, that's very well said. Yeah, very well said.
Purposeful in my language, Nathan. So I'm
That's true. That's true.
So I think we did. I know we're coming close on our time, but I think we probably have time for just maybe the one last question that came through. And I mean, general cost associated to the business for getting one of these started. And then this process that continues on was something that came through that participant wanted to know.
So, it varies, but, we call it's our feasibility study work that we do. And so what that usually involves is we spend time with the business owner, learning about their business, learning about their management team, because the team that is left to service the debt and to get that ESOP running is probably the most important part, to make sure you have people to continue this continuity plan way into the future. So we spend time with that. We spend time modeling based upon the number of employees you have now, what they're being compensated, the level of turnover that happens in your organization, to try to model out what the cash flow needs analysis of that ESOP is really going to be. And then we structure and find if we're going to do a levered purchase where we're going to use a bank versus the selling person taking it back, we go help find some banks to come up with some rates to see what kind of deals might be out there for this to get done. That whole feasibility process it usually takes about 4 to 5 months to really get that done appropriately. And we spend about $25,000 on that component of it. In that process, we also recommend the client get a formal valuation. We're always happy to help them with a back of the napkin valuation for planning purposes, but it's not the one that's going to be used at all. And we usually recommend an outside party to do that valuation. And we have that formally done once we've gone far enough to say, I think that this is a feasible exit option for the shareholders. So, and it is something where we'll start a feasibility study, and then sometimes we recommend, hey, let's take some baby steps and set up a phantom stock ownership plan to see if this management group understands the concept of ownership and can really appreciate what an employee stock plan is going to be before we take that full leap. So the ESOP feasibility studies, I would say probably once the client has gotten to that point, is initially $25,000, and then we might spend another year or two still sussing out and building out what an ESOP might look like for them and the best structure for them, and then the cost of the valuation as well.
Okay. Great, thank you. And
Awesome.
then, yeah, then I guess ongoing, they'll need an annual evaluation, and then are the trustees paid too, or what kind of recurring costs do they have?
I don't have any clients that pay their trust. They pay the outside trustees and some. So yes, there is some compensation for trustees. The biggest part is the administration of the plan. And so that's based upon the number of employees you have. For a 30 or 40 person firm here in the Midwest, for some of the ESOP plan administration places we do, I think they pay maybe like $12,000. You know, like it kind of depends also upon how complex you structure your plan. So if you have a plan with a whole bunch of loans and 150 employees, you probably are paying 25 grand for plan administration. So, but just knowing that's happening every year, no matter what. And that valuation.
Right.
Yeah. Awesome. Thank you. Well, Michele, Nate, Dave, myself, I think we're coming up on 2:00 here. We wanted to make sure we're respectful of everyone's time, but we really appreciate you all joining us here on this webinar. We hope it was insightful and you got some good information from it. There's probably other questions that you might have, and certainly that's one of the reasons why we wanted to bring the four of us on here, is to be a resource. One of the questions that we didn't really get to answer because it's nuanced is, how do I know if an ESOP is right for my family business? I think this last hour has really helped to uncover that the answer to that is it depends. There's a lot of factors that go into whether or not it is right for your family business. But we are certainly here to shoulder some of those questions. If you want to have any more detailed questions, any one of us can be reached out to, and we can certainly talk about that. We'll have some follow-up afterwards. Just if there's questions after this, you're certainly welcome to reach out to us as well. But again, Michele, thank you.
Thank
Nate,
you.
thank you.
Thanks for having me. This is awesome.
Yeah, I can't thank you both enough for attending, and please, for our audience, let us know if you enjoyed this, and if you'd like to hear if there's other topics on succession planning, or if we touch on probably half a dozen, phantom stock, things like that. If there are topics you'd like to hear about, let us know, and and we can get we can pull together resources and do another one of these.
Yep.
Thanks for having
All right.
me.
With
Thanks.
that, I think at least us up here where it's snowing may brave the elements, but if you're safe and sound, you should be good. Oh, you said something come in. Oh, good. Carol, you are very welcome. Thank you for that. All right, everyone, have a wonderful day. Stay safe out there if you're traveling, and hopefully we will connect with some of you soon.
Very good.
Awesome.
Thanks.
Bye,
Thanks, guys.
everybody.
Thanks.